Hello, welcome to our second ever episode of Tax Takes for AccountingWEB, joined as previously by Amy Chin, former taxation editor of AccountingWEB, to look at two or three of the things that have cropped up over the last month or so in terms of tax conversations online. Amy, we start with something which is a very unofficial announcement from the Revenue, or should I say from the Treasury, relating to the threshold for low levels of income. We have a rule that if you earn less than £1,000, profit of less than £1,000, rather turnover of less than £1,000, we can disregard that for income tax purposes. That threshold is going up to 3,000, we've heard, at some point in the relatively near future. But what is curious about this change is that it's not the change an awful lot of people seem to think it is.
No, so this announcement was made by James Murray, and all he said so far is that it will be by the end of the current Parliament. And the change is to the reporting threshold rather than the earning threshold above which taxes would need to be paid on income. So we're talking about what's been widely in the kind of media known as the side hustle. So dog walkers, babysitters, people earning kind of quite low levels, as you say, of income, and whether or not they need to file a tax return. So currently the reporting threshold and the earning threshold are the same at 1,000. And this is just a change to the reporting threshold. So it means that if you are earning between 1,000 and 3,000, which will be the new threshold, you'll still need to report and pay tax on your income. You just won't need to file self-assessment unless you go over the new elevated threshold of 3,000.
The first thing to pick up there is that if you had, let's say, £2,000 of income, once this rule changes, you would no longer have to do a self-assessment tax return if the reason you're doing a tax return is that £2,000 of income. That is the point that we're making here. You would still have to pay tax on it, first of all, that £2,000, but in a different way. And the other thing to pick up on is that while you might not have to do self-assessment because of that £2,000, if you also had, let's say, sizable dividend income or interest or whatever else it might be, you're still in self-assessment. This doesn't get you off the hook altogether.
Yeah, you do. And the Revenue have said, or actually the Revenue haven't said anything yet, but James Murray has said that you will need to use a separate, simpler online reporting service. We don't actually know what that's going to look like, but the idea that will be that you'll be able to tell HMRC that you owe them the money in a much less involved way than the self-assessment.
And the risk here, I suppose, is that people will see this 3,000, think it is the same as the old or the current £1,000 threshold, and assume that income below that isn't taxable. So they won't be coming to accountants, they won't be coming to tax advisors and saying, can you help us with this liability? They'll just be thinking, well, it's less than 3,000, so there's nothing to worry about. That has to be a concern.
Yeah, and without having seen what the new service looks like and what HMRC's plans are around that, I don't think we can really say how many people that's going to be who are just going to end up not reporting and not paying at all. I suppose we do know that, I think it was last month, March, HMRC sent a load of nudge letters to taxpayers who they've identified as being within this category of kind of earning relatively low amounts but above the 1,000 trading allowance, who haven't reported, but HMRC believe should be reporting that they need to pay some tax. So they're clearly looking at it, and of course we also can link it to the reporting requirements for the online platforms who are now actually giving information to HMRC about customers, I suppose, or their customers of the platforms who are providing a service or a product to others above that £1,000 limit. So yeah, the Revenue are clearly keen to ensure that those taxpayers don't slip through the net, but this is definitely going to cause confusion.
So again, the idea is that we have less administrative burdens and problematic admin that we will then have to work our way through to get to the other side of it and be able to deal with it. Another place where we have very problematic admin is to do with payrolling of benefits. And remember that from April 2026, we will have compulsory payrolling of all benefits. We knew this would cause problems. We knew there would be teething problems. I don't think we predicted student loans would be the place that was a problem.
No, I don't think that was anybody's first thought when it came to the mandatory payrolling of benefits, but it is, let's say, collateral risk or damage in some cases. So the calculation towards the threshold of when one should start paying or repaying, making repayments towards their student loan, should not include certain benefits in kind. And the problem here is that now we're moving away, or when we move away from the current system of the P11D at the end of the year, those benefits are going to be included on the payslip every month, and the revenue have suddenly realised actually we're going to need to find a way to strip out those benefits in kind which should not be included towards that student loan repayment threshold. Otherwise, we'll end up with taxpayers unnecessarily making, we call them voluntary repayments, but they didn't even really know that that was happening to them, accidental repayments of their student loans.
And sticking with that idea of voluntary repayment, when I had a student loan many, many years ago, I just wanted rid of it as soon as I could. So if I had voluntarily overpaid, might have been irritating that I had to give them the money, but at least my loan was coming down. An important point with student loans these days is that some people out there, many people out there, will never actually pay off their student loan. And as a result, if you were in a position where you were never going to get to the end of a loan and it was written off after 40 years, any voluntary excess payment it's tax, isn't it? It's not actually a repayment of a loan, it's just a tax charge.
Yeah, definitely, because if you're talking about maybe a teacher or a nurse who kind of dedicate their life to that vocation, that career, and they're always going to be earning sort of just around the threshold for repayments, and maybe actually would never end up repaying their student loan or repaying a very small amount. And once you get to that 40-year mark and the student loan would be written off, then that's fine and you would never have repaid it. If you end up accidentally making voluntary repayments because of this change in the way that your pay is calculated, because of the benefits in kind being included unnecessarily, then obviously you are, as you say, you're just paying a tax, you're giving money to the government that you didn't intend to. And that doesn't only extend to this benefits in kind, that's the teething issue that HMRC have identified currently, and actually they've come up with a solution all to do with the self-assessment tax return. So where you've got PAYE but you're also in self-assessment, it's your PAYE income that needs to not include that benefit in kind. And HMRC have added a new box to the self-assessment tax return to strip out that benefit in kind amount and make sure it isn't included towards the threshold.
We will see, but certainly the direction of travel, it would appear, is set as far as corporation tax is concerned. Thanks, Amy, for picking those points. Some very interesting topics to consider, and we'll talk to you again in a month's time.